A company reports $1 billion in revenue, or $100 million in net income. On the surface, those figures sound impressive, but standing alone, raw numbers lack the context required to make an actual investment decision. To find that context, we rely on fundamental analysis. The objective is to look past the top-line figures in a company's published accounts and extract the meaningful, predictive relationships hidden inside them. The critical translation layer that gives raw accounting data its diagnostic power is the financial ratio. By organizing these disparate mathematical relationships, professional analysts build a structured diagnostic matrix to systematically stress test a firm. That matrix is built on 4 pillars: liquidity, debt, profitability, and valuation. Working through this specific sequence allows analysts to judge 2 distinct mechanisms: exactly how efficiently management deploys its capital and exactly how a broader market prices that performance. Without this matrix, an analyst is simply reading static numbers. With it, they are actively diagnosing corporate health and calculating the exact odds of survival. The absolute foundation of this entire diagnostic matrix is short-term survival. If a firm cannot pay its liabilities today, its long-term strategy is irrelevant. The most basic measure of solvency is the current ratio, which we calculate by dividing a company's current assets by its current liabilities. To cover debts falling due within a year, a healthy firm typically requires a result between 1.2 and 2 times. But this metric has a flaw. Current assets include inventory, which cannot always be instantly converted to cash during a crisis. To fix this, we use the liquidity ratio, also known as the acid test. By completely excluding stock from the calculation, it provides a far stricter measure of a company's ability to survive a sudden cash call. While those ratios test immediate cash reserves, we also need a way to forecast comprehensive, predictive solvency. We do this using the Altman Z-score model. The Z-score distills multiple internal variables, like the firm's gearing and sales mix, into a single statistical probability of liquidation. This text outlines the specific danger thresholds. A Z-score of 1.8 or below is an immediate warning signal, indicating severe financial distress and a high probability of bankruptcy. Conversely, a score of 3.0 or higher indicates a highly robust and secure financial position. Ultimately, exceptional long-term profitability offers zero protection if a firm fails these short-term liquidity stress tests. Once a firm passes the liquidity test, we move to the second pillar, assessing structural risk by analyzing how the company actually funds its operations. We do this by measuring financial gearing, or leverage. This evaluates the specific ratio of debt-to-equity capital employed across the business. In strict accounting terms, preference shares must be categorized on the debt side of this calculation because their dividend payouts take absolute priority over ordinary equity. High gearing operates exactly like a mechanical lever. During periods of aggressive economic expansion, taking on debt rapidly amplifies investment returns for shareholders. However, that exact same high gearing rapidly accelerates existential risk during an economic downturn, when revenues contract but fixed debt obligations demand payment. To test whether a firm's current debt load is actually manageable, analysts check a metric called interest cover. We calculate it by taking profit before interest and tax, dividing it by the required interest payable. As detailed in this section, an interest cover of 1.5 or less crosses a critical danger threshold. It warns that a firm is barely generating enough cash to service its debt, raising the possibility of default. A company's capital structure dictates its resilience to economic shocks. Financial gearing acts as a direct, measurable proxy for a firm's structural fragility. With survival and structural risk defined, we reach the third pillar, evaluating the true output and efficiency of the company's operational engine through profitability ratios. The apex metric used by analysts to measure total operational efficiency is return on capital employed, or ROCE. ROCE calculates the return generated from all employed capital, encompassing both debt and equity. As this expanded formula shows, the denominator relies on total assets minus current liabilities, plus short-term borrowing. There is a specific accounting nuance required here. Bank overdrafts must be added back into the capital employed figure because they effectively function as long-term financing to generate profit. Top-level ROCE is a synthesis of two distinct drivers. The first is profit margin, representing pricing power per unit of sales. The second is asset turnover, measuring how intensely assets work to generate sales volume. Improving either mathematically lifts the total ROCE. Fundamental analysts use this specific decomposition technique to pinpoint the exact internal source of a company's competitive advantage. High raw profits mean very little if the capital required to generate them is inefficiently massive. ROCE reveals true engine efficiency. We conclude with the fourth pillar, valuation. This serves as the critical bridge translating a company's internal accounting reality into its external market price. The baseline unit of measurement here is earnings per share, which isolates the net profits available to ordinary shareholders. We contextualize those earnings using the price-to-earnings, or PE ratio. As detailed in this formula, it is the market's primary mechanism for pricing a company's ability to grow its income stream. A high PE ratio, relative to sector averages, clearly indicates that the market expects the firm to achieve above-average future growth. But analysts must distinguish carefully between the two variants. Historic PE relies on reported past earnings, while prospective PE is built entirely on forecasted future earnings. Beyond earnings, we also evaluate companies by comparing their total market capitalization against their tangible net asset value, using the price-to-book ratio. A PB ratio below 1 suggests the stock is trading at a discount to its literal liquidation value. This signals either severe market undervaluation or a deep structural flaw. Valuation ratios do not determine a company's quality. They strictly determine whether that quality is currently overpriced or underpriced by the broader market. This sequence reveals the supreme rule of fundamental analysis. Absolutely no single financial ratio guarantees a sound investment when viewed in isolation. A phenomenal profit margin is instantly negated if a failing Z-score points to imminent insolvency. And an incredibly low, highly attractive PE ratio is nothing but a trap if massive financial gearing is suffocating the firm's cash flow. Ratios require strict chronological context. They must always be plotted against the company's own historical trends to detect internal deterioration. They also require lateral context. Ratios only reveal true performance when benchmarked heavily against direct industry peers operating under the same economic conditions. By mastering this interconnected four-pillar matrix, an analyst transforms static, backward-looking accounts into a highly predictive model of corporate survival and future value.